Hey everyone, in this video we're going to be looking at the basics of how to construct an options portfolio. And I also want to take a look at the differences in risk profiles on a hedged portfolio versus an unhedged portfolio. So if you are fairly new to portfolio construction, buckle up because we're going to be looking at a lot of information, and I think you guys are really going to like this a lot. So let's jump in. So here you can see we've got our example portfolio tickers here loaded up. You can see this is mostly technology stocks. We've got a few consumer discretionary names, 10 names listed here. I'm trying to keep it simple. So when we're modeling our portfolios, I keep all the data within a spreadsheet. And this is just a sample set of that data just to help you, kind of understand the nuts and bolts of how the portfolio is actually structured. So you can see here, we've got various option structures here. We've got call credit spreads. We've got some iron condors, got put credit spreads. We've got a random, just single contract here on Google, and we've got our hedges. So all of these credit spreads are out of the money credit spreads, and the iron condors are also out of the money as well. We try to keep a nice wide buffer between current market price and our spread itself. What we want to try to do when we're structuring our portfolio, especially with options, we have two ways to diversify. One, we can diversify across industries and sectors. And two, because time is such an important component of option pricing, we can actually diversify our option portfolio through our expiration dates. So we like to stagger expiration dates. You can see here in this portfolio, we've got the April 28th expirations on coin. We've got several with the May 12th expirations, and then we've got several with the big May 19th. That's a big monthly expiration date for the month of May. So we're kind of staggered here. So these positions will be rolling off. And the way we basically manage larger portfolios is we're constantly putting on new positions, and old positions are constantly rolling off as time goes by. So every few days we've got positions rolling off, and we're putting new positions on further and further out in time. So we're constantly having the staggered kind of construction to our portfolio. This portfolio here has got about 10 positions. Each one is around $5,000 cash required to put the position on. So, if you're in just like a regular option margin account, this is going to take about $50,000 to put these contracts on. So, if you had, like, for example, if you had a $5,000 account, you would just be selling one contract as opposed to 10. So everything is scalable, and just for simplicity, we're trying to keep it around 10 positions plus our hedges. And so the crucial thing when managing a portfolio is you need to benchmark your portfolio to some major indices. So obviously the SPY is going to be, probably the most liquid index. It's probably going to be the most applicable index when you have a diversified portfolio. That's typically what we do. We benchmark our portfolio to the SPY, and then our entire portfolio is going to be based on the movement of the SPY. And so I'm going to explain how to benchmark that here in a second. So we actually run a Monte Carlo simulation to model our portfolio's benchmarking to the SPY, so we can see, wherever the SPY is landing here, we can kind of get an estimate for how our portfolio is going to perform. So here we're looking at 30 days out. So this would be after everything is expired. What is our portfolio likely to provide us in profit and risk? Anywhere between, obviously between this 385 to kind of 433, we're in a profit zone here. So you can see here, obviously, if we stay anywhere between 400 and 420, we're going to reach our maximum profit potential, which is $7,200, a little over $7,200 in the next 30 days. And that's essentially what benchmarking does. It's basically saying, based on where the major index you're benchmarked to, in this case, the SPY, how is your portfolio going to perform? What is the risk adjustments that need to be made to your portfolio based on the movement in the market?
If you guys are interested in following along in our portfolio, you can see all the moves we're making, as well as our Monte Carlo simulation and our trade methodology. I'll put a link down in the description below, and there's a link in the pinned comment below, so definitely check that out.
And so the way we've structured our portfolios, we have this nice kind of bell curve shape here, giving us a nice buffer that, if the market just moves, 5% or so in either direction, we're still going to be in a nice profit zone. Now you can see we have these big nasty tails here that, like, if the market were to sell off 7, 8, 10% in the next 30 days, we'd have a pretty nasty loss. Again, if the market rallied 7-10% in the next 30 days, we'd also have a nasty loss. So we've got these big like $15,000 losses, which if you think about it, our portfolio, we were saying at the beginning, our portfolio was around $50,000 to put this on. Based on a $50,000 portfolio, $15,000 losses are really they're just not acceptable. I mean, as a portfolio manager, you'd be fired immediately if you were taking this kind of risk. This is basically losing 30% of your portfolio within 30 days. That's your risk here. And this is a real risk because we know the SPY can move 10% within 30 days multiple times a year. These are the kinds of risks that we want to hedge away, and we want to know where those risks lie when we're constructing our portfolio. So this Monte Carlo simulation helps us do that in very complex portfolios, but I'm going to show you how to do that here at the end of the video. I'm going to show you how to benchmark all your positions to the SPY manually and how to calculate your benchmarks so you can know where to hedge your portfolio by just doing some simple calculations. So here, looking at this Monte Carlo simulation, obviously we want to hedge, we want to have the maximum potential for profit. So we want to hedge away these losses as much as possible. So there's many different ways to hedge. Because we're benchmarked to the SPY, the most easiest way to hedge is by buying calls and puts on the SPY to hedge these tail risks. Now, that's a somewhat inefficient way to do it because calls and puts on the SPY are typically way overvalued. But for the context of this portfolio, it's okay to overpay a little bit for your hedges. Here we can see it's kind of 390 to 385 level. That's where we start getting into the danger zone of big nasty drop in the value of our portfolio. This is where the losses really kick in. And here on the positive side, you can see it's a 430, 435 level. That starts getting really nasty there. So those are kind of our levels that this model is telling us that we want to hedge. So just going back here to our example portfolio, we basically were running this without our hedges in. Basically, this is our structure for the model that we just looked at. Now I want to look at the model including our hedges. So we're going to run this model again, 30 days out, and we're going to see at expiration, after all these contracts have expired on May 19th, if we hedge the portfolio, what does our model look like? Can we hedge away these risks? And what's our max profit going to be? Remember, our max profit here is 7,200 if we're anywhere in this zone on the SPY, anywhere between like kind of this 390 to 430 level, we're making over 7 grand. 5 to 7 grand here. So how much is it going to cost us to hedge the portfolio, and how much can we minimize these losses? So now we're looking at our model Monte Carlo simulation with our hedges included. So you can see here our max profit is around $4,700 on the portfolio. This is our max estimated profit, of course. It's $4,700 versus the $7,200 without the hedges. So we're spending like $2,500 on these hedges, which is very expensive but necessary in this particular portfolio. Because look at how much our max loss is here, $2,890 at the very worst case scenario if SPY closes at 380 on May 19th. And you can see here, same on the upside. So we've hedged away most of the market risk. Now, we can never really hedge away company-specific risk, okay? So these hedges, these SPY hedges, are hedging away market risk. So if the market as a whole sells off or has a huge rally, we are protecting our portfolio as a whole by buying those calls and puts on the SPY. You can just, you could just see here our hedges specifically. We've got a put spread to kind of lower our costs. We're buying the 390s, selling the 370s, expiring May 19th on the SPY. And on the upside, we only needed to buy 5 of the 430s, just the way our positioning is here, in order to hedge most of that risk away. So we went from being, losing potentially $15 or $20 or even $25,000 here on the downside, and similar on the upside, we've gone now to where our losses are very, very small. So if for some reason, in an unlikely scenario, the SPY, sold off 10% or rallied 10% here in the next 30 days, our portfolio would be protected. And that's the goal of constructing a portfolio like this. You have a high probability of landing somewhere kind of in this zone, this kind of 5% zone around where the SPY is trading now. You're hedging away most of your risk. So you have a very small chance of losing a couple $1,000s. You actually have a much higher chance of making $4,700. And so, by putting on this kind of portfolio over and over and over again, and constantly maintaining a portfolio where you're hedging away your market tail risk as much as possible, and you are keeping most of your profits centered around where the index is trading now, and you just continually put on those diversified positions and staggering various expiration dates, this is a profitable strategy that we have implemented, over the course of the past several years. And so by using this approach, you're giving yourself a really high probability of success. And, even though we're not making $7,200 here in our best case scenario, it's gone way down to $4,700. Remember, this is based on a $50,000 portfolio. I mean, we're making almost 10% if we land anywhere in the zone here in the next 30 days. So we have a high probability of making 10% on our portfolio while minimizing our portfolio losses in an unlikely scenario. So most of the time, our portfolio is going to fall within these ranges here, and a small percentage of the time, maybe 10, 20, 30% of the time, we're going to fall in these ranges. But it's okay because we're only losing, a small percentage here. And we're talking about market risk here. I mean, we can never completely hedge away company-specific risk. That's always going to be an outlier. This is why it's important to have a diversified options portfolio, or any portfolio that you're managing needs to be diversified, because you can't really hedge away company-specific risks. So if we're selling a call credit spread on Adobe, we can't really hedge away that risk. I mean, that's our risk on Adobe. So if some company-specific event happens to Adobe, that is a risk to our position. We could realize our max loss on that position. And that's why we want to have a diversified portfolio of positions, because there are going to be times where, individual positions go against us. Even when everything else works out, our market risk is hedged, we can still have a position that goes against us. So for example, in this portfolio, we're showing, a profit potential of $4,700. Well, for example, if Adobe goes against us, that could be a $4,000 loss just on Adobe. Right? So that would negate most of these profits. Okay. So that's why, it's really crucial that you have a diversified portfolio, so that, any position that goes against you is really going to be only a small loss out of your total potential profits in your portfolio. But this is just an example. We're trying to keep it simple, just to show you guys how to structure the portfolio itself. So when it comes to managing an options portfolio, you want 2 or 3 things in place. Number one, you want to have the biggest buffer possible on the majority of your positions. So we were going through each of our positions here and the buffer we had on each of these. We went through each one. We had like 5-7% buffer on some of these. That's what you want. Number one is you want a big buffer on each of your positions. Number two, you want to benchmark your overall portfolio to a major index. And number three, you want to calculate the areas where you need to hedge that portfolio in order to minimize those downside risks or upside risks, as it may be the case. So now I want to take a look at benchmarking an options portfolio to the SPY. So the main formula we're going to be using is your contract percent buffer divided by the stock's beta is going to equal your SPY buffer. That may sound a little confusing, but let me explain. Let's take, for example, Adobe. That's one of our components to our portfolio. We were selling the Adobe 405 calls expiring May 19th in that example. Adobe's price was currently trading around the 376 level. Adobe's beta is 1.272. A quick note on beta. Beta, if you're not familiar, is the stock's sensitivity to movements in the overall index. Beta is usually benchmarked to the SPY. So when you're looking at beta, most beta figures, unless they're otherwise noted, are giving you a 5-year sensitivity. They're looking back 5 years of price data, and they're measuring that stock's sensitivity to movements in the SPY. So for example, if your beta on a particular stock is 2, that means if the SPY goes up 1%, your stock is likely to go up 2%. If the SPY goes down 1%, your stock is likely to go down 2%. So it's a sensitivity can be either up or down. In this case, Adobe's beta is 1.272. So that's basically saying, like, if SPY goes up 1%, Adobe is likely to go up 1.272%. Again, this is a model. It's not exact. It's just like over time, this is what has happened in the last 5 years with Adobe. So it's a good way to model overall portfolios and benchmark overall portfolios to the major indexes, in this case, SPY. So we were selling the 405 call credit spread. So our 400 call contract has a 6.38% buffer from the current price. Okay, so we're selling the 400 calls, we're buying the 405 calls. So we have basically 24 divided by 376 gives us 6.38%. So let me just write that out here. 24 divided by 376 equals 0.0638. And we do the same thing for the 405 call contract. Basically, we're saying 29, right? So it's 405 minus 376 is 29.29 divided by current stock price 376. It's going to give us 0.0771. So our SPY benchmark break-even buffer is 6.38%. Divide that by the stock's beta. That's going to give you our SPY buffer. So this is basically saying if this SPY goes up 5%, we are going to reach this 400 level on Adobe. If the SPY goes up 6%, we're going to reach this 405 contract level on Adobe. This is important because this is our max loss. If on expiration Adobe is sitting at 405, we're losing our max amount on that trade. So we don't want to be, we want to know where that risk is, right? We also want to know where is our risk where we start losing money. So here I'm using the 400 call contract. Technically it's going to be above that because we're getting a credit when we're selling this credit spread. But just to keep it simple, we're going to say, where is our 400 call contract? Here, this is basically just very simply telling us between a 5% and 6% upward move on the SPY is going to start hitting our Adobe position. Okay, it's not guaranteed, but it's just saying according to the stock's beta, the sensitivity of Adobe to the SPY, if the SPY were to move up between 5 and 6%, we could potentially see our max loss on our Adobe position. And you want to do this for every single position in your portfolio. It's a little tedious, but what this is basically going to do is going to allow you to calculate where to hedge your portfolio using SPY. Because of the way we structure our portfolio, this is basically going to be the case for almost every position on our portfolio on those call credit spreads, and similarly on the downside on those put credit spreads. So the final step is basically saying for that particular position for Adobe, we know our max loss is $4,000. So we know if the SPY goes up 6%, our max loss is going to be around $4,000. So for that particular position, we need to hedge ourselves in a way where if the SPY goes up that much, our hedge will provide $4,000 risk coverage. And so we would want to do this for every single position in our portfolio. It's a little tedious, but it's well worth it. So here we could say if the SPY goes up, you can see I've just identified these two columns. SPY goes up 6%, SPY goes down 6%, just to keep it simple. And so you're going to see here, it's going to vary based on the position. On your put credit spreads, you're actually going to be making money if the SPY goes up. So that's going to offset some of your losses. Like when you're benchmarked to the SPY, it's basically a saying that both Adobe and Snow are likely to go higher. Adobe is going to go higher, causing us to lose on this call credit spread. But Snow, for example, is going to go higher, causing us to make money on our put credit spread, right? So let's say our gain on that credit spread was $1,000. That would offset some of those losses. So you want to go in here and do this for all of your positions, max losses, max profits, and where on the SPY those are going to occur. That's going to tell you how much total risk you have and at what level you have. Is it SPY 6%, 5%? You can go through, you can average each position out and then calculate how much money you need to spend on hedges. And so essentially that's what we've done here in our Monte Carlo simulation. And we've included those hedges, those SPY hedges, which are costing us $2,500, but we know we've hedged away that, massive $20,000, $30,000 risk that we previously had. This is how you want to manage your options portfolio. Our portfolio is structured in such a way that we are selling around the SPY price. SPY is currently 414 at the time of this recording when we ran this program. So we're sitting right here in the middle of this portfolio construction. And so you can see we're kind of positioned around the SPY price. So if the SPY were to move drastically, then we would want to reposition our portfolio, of course, but again, we're minimizing our losses. So that's the kind of the core idea of this strategy. And that's really what I wanted to show here in this video.
Don't forget, if you guys want to follow along in our portfolio, you'll also get access to our Trade Ideas dashboard as well as our gamma exposure data. You can get a 1-month free trial, link down in the description below. Thanks so much for watching, everybody. I'll see you guys in the next video.